Welcome back to, and thanks so much for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Scott Kirshner and Chaz Price. 419-794-3030 is the phone number. Once again, 419-794-3030. Online, arhq.com. I know tax day is come and gone, and most people probably don't want to talk about that anymore, but here's the truth of it. There is a major tax event around the corner coming in 2026, and that is the expiration of the so-called Trump tax cuts, formerly known as the Tax Cuts and Jobs Act that was passed in 2017. Guys, what do people need to understand about this when it comes to big picture tax planning, and what do they need to consider for the next couple of years?
Yeah, thanks, Chris. So taxes, just getting done with the tax season. I think everybody does a sigh of relief and says, close the book on that year. Nolan, talks about that a lot. And one of the things that, one of the shortcomings of the tax industry, and they do a lot of great things for us. They help record what happened in history, but not a lot of times is your CPA, your accountant, doing some forward-looking estimates about what the future holds. And so, as you bring up, there is a major tax event coming up in 2026, and it is the expiration of the so-called Trump tax cuts. And so, for all of his failings, I think if there were any feathers in the cap sort of legislation that President Trump passed, was this Tax Cuts and Jobs Act in 2017, and it did make a major overhaul of the U.S. tax code and some fairly sweeping changes. I just want to run through a couple of them so you kind of know what context we're working with here. And so, first of all, it lowered tax rates for individuals and corporations, with the top individual rate dropping from 39.6 to 37%. It doesn't seem like a big deal, but in general, tax rates, these are some of the lowest tax rates that we've ever experienced in our history. Taking it back to the 1960s, I think the highest tax bracket at that time was 88%.
Wow.
Yeah, and
88%.
88%, and I think that's one of the impetuses for President Reagan's aggressive tax cutting platform that he ran on, is because he probably was paying, when he was doing movies, he was paying 80 to 90% in tax, and I think that's, I've read that somewhere. So it lowered tax rates, the top marginal rate, from 39 to 37. It also increased that standard deduction for individuals and families, which we all enjoy. So if you're not itemizing, meaning keeping track of individual expenses, you get a nice hefty standard deduction that really helps during tax time. And then it also changed and it put caps on some of the state and local tax deductions. It eliminated some other deductions in its place. But for the most part, I think it was a pretty, again, monumental sort of legislation. And so the takeaways there is that things are expected to change if we don't make any updates to that tax code. And one of the other big takeaways here is the exemption, the itemized deduction that you get as an individual to pass money on to anybody during your life or at death. The lifetime exemption, the personal exemption there, went up to about $11.7 million. Depending on what happens, that could go back to where it was before 2017, which is around $3.5 to $5 million. So what that means is that right now, individuals can pass $11.7 million to any individual during their life or death and not pay any estate tax or gift tax. Whereas, if those tax cuts expire, people that traditionally weren't worrying about having to pay any estate tax may have a pretty significant estate tax problem on their hands. And so that just kind of gives you the idea of, maybe you're not in that situation now, but maybe you need to start planning for that. If you're floating around $1 million in 401k and retirement savings now, what's that balance going to grow to by the time you get to 70, 80, 90? Is it going to be over $5 million? So it definitely is a big event that we haven't seen, any big tax changes like this in a while. And so it's going to take probably a lot of legislative brain power to get our arms around how this is all going to work, because the budget deficit, we're continuing to run trillions and trillions of dollars of deficits. We have already over 30 plus trillion dollars in combined federal deficit. Social Security, and I'm not trying to bum you guys out, but Social Security is on kind of a press-up of teetering between that trust fund of running out soon. How are we going to pay for all this? The only way that I can see is having to increase taxes. And so it's not even just so much the tax itself, but the overarching situation that the United States is in financially, that we as investors and retirees really need to strongly consider, how we're planning and what our sources of reliable income are going to be, because it may look very much different in the next 5 to 10 years than what you were planning for in the conversations that you were having when you started planning for retirement. It's an interesting case study. We're all kind of watching it unfold,
So Chaz, here's what I'm hearing from you. And I've talked with a lot of clients. I did an event a couple of weeks ago and had one particular client come up and talk to me about some issues that they have. They're in income of roughly $350,000 a year, and they're looking at what are the costs going to be. They're in their mid to late 60s. Actually, they're 67 years old, okay? And a big question for them was they got an issue that they're dealing with their HSA that they're still contributing, but they signed up for Medicare, so that's a whole other topic of discussion. But one of the things I mentioned to them was, okay, they kept asking me a question. Let me jump back here. They kept asking a question, and the question was very simply this: what income levels affect Part B premiums? So, and she kept asking and asking and asking. So after we were done with the event, I went up and talked with them, and I didn't want to get into their specific needs in front of a group environment, but I found out that they're making over $350,000 a year. They've got some assets put aside, and I said, "Do you have any Roth IRAs?" And he looked at me and said, "Well, not really." I said, "Here's what you need to consider. With a Roth IRA, it's not reportable income, so it's not going to impact that Part B premium." So based on what you were saying, with taxes as low as they are now, with the uncertainty in coming down the road here, don't you feel that right now is a great opportunity to do some conversions and roll money into Roth IRAs?
Absolutely. You hit the nail right on the head, Scott, and you're right. So taxes, they're inevitable. We're going to pay them at some point. So the concept of a Roth conversion is, do we pay some taxes now,
right,
and lock in some tax-free benefits for the future? So kind of pose the question in a different way is, from the farmer's perspective, does it make sense to pay tax on the seed or the harvest?
Right.
And I think everybody would agree it makes sense to sometimes pay tax on the seed and get that out of the way, especially now since the stock market is down. So when you think about converting assets, whatever dollar amount you convert, let's say if you had a stock position that was worth $100,000 a year ago, now it's down to maybe $85,000. If we move that stock position into your Roth, it's called a journal. We create a taxable event, but we pay tax at $85,000.
Right.
We're not paying it at its full market value or the higher market value that it was a year and a half ago. And then what we've done is we've locked in then any future growth back, recovery from that stock in a Roth IRA. So it's tax-free, helps keep some of your premium costs down for or for health insurance.
Sure.
I think it makes a lot of sense. And also, we need to start looking at that process of converting up until 2026, because at that point we may, tax rates might be too high to actually have it be a viable solution.
So here's another question that I have, and the gentleman posed this at me. He said, "Well, we can't do a Roth conversion because we make too much money." Is there certain thresholds on how much money you can make in order to do a Roth?
No.
Because I didn't know. There again, that's your lane, not mine. But when he said that, I'm like, yeah, that doesn't make sense to me. So that's why, I'm taking this opportunity on the air here to actually ask that question
Correct.
of you. Is there any income levels that will prohibit you from doing any kind of a Roth conversion?
Not a Roth conversion, but contributions to your Roth, you could be phased out depending on what your income level is and your filing status. But no, there are no limitations on Roth conversion. So that's good that you brought that up. So again, any listeners out there that want to pay some tax now, while taxes are on sale,
Right.
it's kind of like being at the grocery store, and two things when it comes to the sale is what is it, or actually three, what was it before the sale, what is it now, the price, and how long does the sale last? Well, this tax sale is lasting until 25, 26. Shouldn't we lock in some gains here, pay some tax on them, and get them into a Roth? But yeah, there are no issues with making too much money on a conversion. In fact, some of our higher wage earners, we use a strategy called a backdoor Roth IRA. And so if you're in a situation where you have a 401k and want to convert some of your IRA assets to Roth, we can kind of do it in such a way that'll help you avoid any penalties or any of the testing requirements that are associated with that, because there are some limitations in terms of
Sure.
converting always, but there's the income limitations don't apply in this case.
There are certain things that we hope will be true in the future and things that we definitely know will be true in the future. We hope that the money that we have, saved away is going to grow over time. And then we know that taxes, even if they don't do anything, which is a big if, they don't do anything when this Tax Cut and Jobs Act sunsets, it's going to revert back to the previous tax code, which is an increase. It's probably going to be more than that. So if we know taxes are going to go up and we hope that the money that we have is going to grow, don't we want to let that growth be as tax-free as possible? There's a lot of merit to taking advantage of this and doing something, looking at Roth conversions, making sure you're methodical about it. It's not as easy as converting everything all at once, because that's going to be a cut off your nose to spite your face situation. So to figure out the right strategy, it all starts with a little bit of planning. ARHQ.com. Actually, before I do that, there's another website, usdebtclock.org. I don't recommend you go there that often.
No.
But it shows what the debt is at this moment. Right now, $31,703,000, and it keeps going up and up and up. It's very depressing. Don't spend a lot of time there. Go instead to ARHQ.com. Set up a time to speak with the team at America's Retirement Headquarters, or give a call, 419-794-3030.